Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a business valuation expert focused on strategic planning and exit planning in St. Louis, Missouri. Today, we are talking ERC tax credit information for advisors and business owners with Catherine Tindall. She's a CPA in California, specializing in tax credits, and is also a partner with Dominion Enterprise Services. She's combined proprietary technology with professional expertise with her CPA team and is able to offer a fast turnaround time on credit claims while maintaining a high degree of precision. It's her mission to help business owners in key industries affected by COVID shutdowns, such as restaurants, construction, and hospitality, to take advantage of the employee retention credit before it begins to expire in the spring of 2024. Welcome, Catherine. How are you?
I'm doing well. How are you? Thanks for having me.
Well, and I think that when we're looking at like if I'm eligible and if we're like trying to look at some of the signs of whether I'm eligible, the other thing that I have to consider is that since it's a credit and it like a one, not a one time, but like since it's not going to happen again in some capacity, um, is it really easy to identify, well, this is what I'm giving up, this is what I'm not giving up? Or, you talk a lot about an assessment and
Mhm.
having, somebody kind of at least preliminarily look and see, are you eligible? Are you, is this a possibility? If it's a $26,000 credit up to for each employee and you have 100 employees, it would be realistically rational to at least see if you're eligible because there are other ramifications of it. But
Yes.
like just preliminarily, like if you know some of these three signs, it may be that you need to have an additional discussion, not necessarily with your accountant, but maybe with somebody who knows these credits. What are some of the signs that I could at least be looking for to know whether I need to ask questions?
Yeah. So I'd say the first piece is, if you've got over a head count of, I usually tell people 10 employees, you should have an actual conversation with a professional that's going to talk about your specific situation, because I've had people who thought that they weren't eligible from just trying to self-assess, and they missed some nuance, or they missed some loophole, or just misunderstood some of the tests. So that's what I usually tell people. If you've got more than 10 employees, you know multiply that by $26,000. That's the upper cap of what you could be eligible for. It's worth having, a couple phone calls and really digging into it more. And then for the actual program itself, the things that we look for, the first piece is we're looking for quarterly revenue declines. And so what I usually just tell people is that if you didn't have a quarter over quarter steady revenues or consistent growth revenues, you'll want to have a tax professional look at it. If you have any kind of dips in one quarter compared to the same, so this is for tax years 20 and the first 3 quarters of 21 for most businesses. If you had any kind of revenue dip in 20 or 21 compared to the same quarter in 2019, that could potentially be enough for you to qualify for the program. Now, there's specific limits and everything for the program. So for tax year 20, it's 50%. For tax year 21, it's 20%. But I just usually tell people, most providers will do this assessment for you as a complimentary thing. I know we do. And so why try to DIY it? Just send your stuff over to somebody who will actually run the number and make sure they're getting you the right information. So that's one major sign is the revenue. Not consistent revenue growth or stable revenues over quarters. We're looking for dips. And then the second, like I mentioned, that, government interference in your operations. It sounds really vague when I say it like that because, that's how I lead that question. We actually have a lot of bright line tests from the IRS. So we're able to, it is a quantitative test. We have to be able to demonstrate certain things, that you meet certain operational disruptions that are going to qualify you for the credit. But we're looking for things like, a restaurant was subject to indoor dining capacity restrictions due to a state order, or you run a chiropractor office with multiple locations and you weren't allowed to run, you weren't able to run your operation at, full capacity because of social distancing requirements that were enforceable by state orders, things like that. And so it's, you want to talk to somebody who's going to get through the nuance of it. But then also we look and find the actual government orders, because that's what the IRS wants. But if you had anything like that going on where the government was, you were directly enforced to do certain operational changes, it's worth having that conversation with a professional about it to see if it rises to the level of eligibility. But that's what we look for.
And typically when we were looking at the PPP, we were also, especially the second round of funding, we were also looking at that kind of volatility.
Yes.
And you were talking, when we were talking about this earlier, you were even talking about like quarter over quarter. If somebody's not analyzing it in that capacity, that could also be another way to look at it differently. It's almost like you should assume that you could get the credit and just see if it's worth it for you to do what is required, right? Because it's not as simple, right? In that capacity. Like it's not going to be an automatic deduction this year, right? It's sort of in the future, or no?
Well, so, I usually tell people like, assume it's like if you've got like a lump on your neck, it's like assume that it's cancer until proven otherwise. It can potentially be such a big deal that you want to assume that it's an opportunity for you until proven otherwise. That's not to say that every business qualifies. That's definitely not the case. It's really idiosyncratic to what was going on in your company during the pandemic. But yeah, it's, if your company is eligible for it, you're legally entitled to the money. It's not like PPP where it's a limited fund pool or it could run out or Congress will change it or it'll stop. Because it was written as a tax credit, it's like when if you filed an income tax return and didn't claim all your deductions, you're allowed to go back and amend that return for deductions you missed that you were legally entitled to. This program operates the same way. So unlike with PPP, where it was basically once the money was out, if you were eligible but didn't do it, too bad. This program's not like that. So you can still go back and get it. That being said, IRS processing times are really slow right now. So it's not going to come. We're recording this the end of 2022. So you're not going to see any funds until 2023 at this point if you filed today. But, it is, it's once you've proven that you are eligible for it and you have the right documentation, it's kind of an in the bag situation. You're legally entitled to it.
Yeah.